The ATO introduced Division 7A rules to stop private companies from distributing tax-free profits to shareholders and directors as loans. Unfortunately, the rules are not there to protect us. The rules are there to tax you even more. At my accounting firm, Box Advisory Services, we make sure our clients know how Division 7A rules work and what their responsibilities are so they can avoid getting double taxed with the ATO. This video is a recording of a coaching session I have with my clients where I cover what a complying Division 7A loan should look like, advantages and disadvantages of these loans, and what to consider before you take them out. So let's get into it.
So when an accountant and a client or a small business talks about Division 7A, it's not the way that the ATO talks about it. Okay, it's very confusing when I say that, because the ATO talks about Division 7A as a way to clamp on businesses that are avoiding tax. So that's the big difference. The way we talk about Division 7A is that we're just drawing money out of the company. How do I draw the money out of the company and not pay tax on it? Okay, whereas the ATO is saying, if you've taken money out of the company, you're paying tax on it. So that's their perspective. And then our perspective is we drew money out. We're not going to pay tax on it because it's a loan. But whereas the ATO says that this money that you've taken out is not a loan, it's unfranked dividend. It's money that you've taken out, so we're going to make you pay tax on it. So their stance is that they're not going to teach you how to take money out and pay no tax. And your stance is, I've taken this money out, I don't want to pay tax on it. So when you read the rules and like the legal legislation, it's very confusing. Like that's why a lot of people, when they talk about Division 7A or drawing money out of the company, they get so confused when they read like the data and the information online. And the reason why it's confusing is because the ATO and the lawyers and the people, accountants that post information online, they post it in a way where they talk about if you do this, it's illegal. and as a result, we're gonna tax you. Whereas they don't tell you how to avoid the situation, because then technically, if you try to avoid the situation, it's seen as a tax scheme, and then you get hit by anti-avoidance rules. So right now, I'm just sharing my screen, and if you read the definition of a loan under Division 7A purposes, is if you advance money, a provision of credit, or any form of accommodation, a payment to a shareholder or associate. So it doesn't have to be you specifically as a director. It could be anyone that's a shareholder or associate of a shareholder. So it could be like, your wife or your kids, your grandparents, and it could be any type of transaction that's the same form of a loan. So the ATO doesn't talk about, okay, well, is it taxed or is it not taxed? Or like, what's the tax rate or how to avoid the tax? They don't teach you the rules of how to avoid it. They just tell you straight, if you do it this way, then there's going to be tax on it. And they don't go too specifics. And when they do explain it to you, it's like between the lines. That's why it's very hard to understand. And that's why it's good to have an accountant to kind of explain this to you. So this definition, it's basically saying that anything you draw out of the company for personal use, it's basically a loan. And it's governed under Division 7A. So the ATO will treat it as a loan. So they got an example here, Terry Pty Limited. So loans $20,000 to Anne, and Anne is a shareholder of Terry. The money is loaned to Anne on the basis that she pays it back when she can. $20,000 is a loan from Terry to Anne because it's an advance of money. And then they say Division 7A may apply. So what the heck does Division 7A mean? So what it means is basically the ATO is saying that, let me just unshare my screen, that if you have this loan and you don't do anything about it, you don't have a loan agreement in place, you don't have a commercial loan rule with the company, then they don't actually think that it's a loan. They think it's an unfranked dividend, money that you've drawn out of the company, it's profits, and they want you to pay the tax in your personal name. That's how they see it. If you don't have proof that it's a actual loan with loan terms, with agreements, with interest, with minimum repayments, then they will then see it as you don't have the proof to record this as a loan. So therefore, we're going to take this as a distribution or a wage or a dividend. Yeah. And the way they see it is that they'll take it as unfranked dividend. So a lot of people would then talk to friends about it. And a lot of friends would say to you, I've taken money out of the company all the time. I've never paid any taxes. And the reason why is that when you take money out of the company, you report that to the government. So over time with the ATOs, that the ATO can't figure out that you've taken money out of the company. It's over time in the next year and the year after when they've got a bit of information from your personal taxes and then the company's taxes. That's where they can data match. They can see that your income in your personal name is very low and the money you've drawn out of the company is very high and nothing's happened over it. And there's no point for the ATO to tax you at the start. They tax you at the next year or the year after because they need to wait at least 12 months, around about 12 months for the loan to actually mature into a proper drawing. And there's a cutoff date where they say that it's the next year's, basically the lodgement date of your tax return, which is next year, for it to become a problem for Division 7A. So that's kind of like a bit of an introduction of how Division 7A works. So the ATO basically says that if you don't follow the rules, then we treat this loan as a dividend and you pay taxes in your personal name. Whereas in our eyes, we try to avoid you getting to that point where you have to pay the tax. So that's what how Division 7A works. And I've kind of drawn up a structure, a group structure. I just want to show you guys how it kind of works. So this is a Division 7A loan problem, right? So a client owns 100% of the trading company and that trading company trades. Over the years, say in 2023, it made profits of, say, $400,000. In that $400,000, during the year, it decided, during the year, there was all this money sitting in the bank account, about $400,000 over the years, over the whole year. And it decided that, look, I'm going to take $200,000 because I'm going to put it down a deposit. So this individual decided they wanted to buy a property, put down a deposit of $250,000, and he didn't have that much savings. He only had savings of $50,000. So he needed more money, and he thought that, I own this company 100%, so I'm going to take that money out, take $200,000 out, and I'm going to draw it out and put it into here. So therefore, now I have $250,000. So if you have $250,000 for a deposit, that's usually enough for you to buy an asset for, say $1 million. And if you did my webinar or deep dive last week, you would know about how it all works when you put in down a 20% deposit. So this person anyway just bought a property in their personal name, probably their home, and took the $200,000 out. And that's it. From that $400,000, I also wanted to mention that this employee also, this director, also paid himself $100,000 in wages. That's how they got the saving of $50,000. They spent some money on, rent, expenses, personal life, and then they left over $50,000. And then they took the whole $250K, put it down in deposit. Okay, if you don't do anything about it and you don't commercialize a loan and take in consideration Division 7A, this is what happens with the ATO. The ATO then decides that, okay, well, from this $400,000, we're going to tax you. There's going to be tax on this. So the tax on this is 25%. Yep. And then you pay that. So from that 400K, it goes down to 300K. That's your net profit. So, and don't forget, wages have already been taken out of this. So this is actually on top. So this wages. So that's net profit after wages have been paid. So this 100K already goes to this person, but they've already spent $50,000 of that 100K and paid taxes on that too. So there's only left over 50K. But what happens here is the ATO has taxed this, and then they go, well, you've taken $200,000 out of this company as well. And because it's not there's no loan agreement, you don't meet the rules of Division 7A. What we're going to do as well is we're going to apply Division 7A rules. And as a result, that $200,000 is going to be treated as an unfranked dividend in the individual's name. So now in the individual's income, instead of it being only $100,000 for wages, so wages is $100,000 and the tax has already been paid on it, they're going to take up unfranked dividend as well. And that doesn't just happen automatically and it doesn't pre-fill into your tax return or anything like that. The only way the ATO figures this out is they audit you. And when they audit you and they see the $200,000 come out of the bank account company and get put into this individual, they won't ask the question, what is this $200,000? The first question they ask is, please send us the loan agreements that you have in place, if you have any. If you say that I don't have any, then bang, they will do the search. Once they find this $200,000 taken out of your company, then they'll ask you again, what's this $200,000? You said, oh, I drew this money out as a loan, or, I took it out, I'm going to pay it back. The ATO goes, well, that's not good enough. There's no loan agreement in place. So as a result, we're going to make you pay taxes on $300K. And don't forget, that tax has already been paid. Usually you're supposed to get an unfranked, like a franked dividend and a credit for it, because the company paid some taxes on it. In this case here, because the money was not treated as dividend properly, tax wasn't paid already, and you've taken $200K out, and there was no like a commercial loan on it. There was no interest repayments or anything like that. The ATO then taxes this as well. And then, as most of you already know, if your income is over $300K in your personal name, most likely you will get hit with 45% tax on the income over $180K. So you can get taxed quite a fair bit. There's a lot of money. And if I just put it in the pay calculator and put in $300,000 in a year, the taxes is close to 120K. So you're going to be paying 120K. Okay. And in this situation, for this person, what happened to their money? What did they do with their money? I'm telling you, they do exactly what everyone here does and what I've done in my business as well. They go and buy an asset, personal home or investment asset, and the money's gone. So they need to cough up with 120K. And yes, sure, they would have paid some taxes in their wages, like $20,000, but they're then left with another 100K worth of taxes they need to pay in their personal name, as well as they paid 100K here. So they've effectively got double tax on the profits they made. Yeah, so this is what Division 7A is, and that's the biggest problem that we face as business owners. And the reason why they have these issues, like a lot of people have issues, is because of the fact that the accountant doesn't do their tax returns until the end of the year or 2 years later. So the money's already been drawn out, and we can't do anything about it. So that's why the best time to do something about it is before 30th of June. About any time between April to June, you should look at your numbers. You should check out how much money you've drawn out of the company. And then you need to work out, okay, well, do we pay this money back and, just clear out the director's loan so you don't have a loan between the company? Or do we set up a loan agreement between the company and you, check out the interest, work out the repayments, follow the rules, what the ATO wants, and so you don't have any problems. That's how Division 7A works. Cool. Does anyone have any questions before I keep proceeding?
Will the ATO apply this retrospectively, for how many years? Is this applicable only to this financial year?
Yeah, so that's a very good question. The way that Division 7A rules happen is if you don't pay back this loan before 30th of June, it's not a problem. You got till the due date of the tax return, which is usually the 15th of May or the lodgement date of when you lodge your tax return if you lodge it earlier. So let's just say that you have $200,000 sitting as a loan from the company. You've drawn that money out. So let me just go back to this screen. This person here has drawn $200,000 out, didn't properly create a Division 7A loan properly. They have until the 15th of May, 2025 to pay this $200K back. If they do that, then the ATO won't do anything about it. Okay? All right.
It doesn't matter when is the loan taken. I think was my question. The $200, if it was taken, let's say 5 years back.
Yes. Yeah, perfect. I was going to go to that. But yeah, so basically just to answer just to like provide a bit more of a background, this $200,000 was taken between the period of 1st of July 2023 to 30th of June 2024. That's really important to know. So if you pay that back before 15th of May, no problems whatsoever. If you don't pay it back before 15th of May, it gets unnoticed. You lodge your tax return, you don't do anything about it. The ATO basically won't figure this out until multiple tax returns are lodged. Okay, the reason being is once you lodge the tax return for 2024, it's not technically a problem because you still got 15th of May 2025 to pay for it. So they won't do anything. They actually don't do anything for the next year until 2025, 30th of June. They still won't do anything because you haven't lodged a tax return to show that you haven't made the payments yet. So it's actually 2026 is when you lodge your 2025 tax return is when the ATO finds out that you have not actually paid this $200,000 back and there's no loan agreement, there's no interest calculated, there's no nothing. That's when the ATO can go after you. And to go back to your question, to answer your question, there's no date that they cannot like prosecute you for. They can even go back 5 years, 10 years, and if they audit you, most likely they'll go at least 3 to 5 years. So they can get you for 3 to 5 years. The ATO would not do anything for the first year or second year because you actually have time to rectify the issue because you can pay back the tax return, pay back the $200,000 before 15th of May 2025. And the problem is they don't actually know the problem exists until 2026 when you lodge your 2025 tax return. That's where so many people get caught out, and that's where the ATO can create like havoc to the client. And that's why a lot of people say, oh, my accountant's amazing. They don't actually know that the accountant's creating like a slow ticking time bomb where like there's this big Division 7A loan or like, they call it debit loan account where you're drawing money out and no one's doing anything about it. And they're going, oh, I'm just paying 25% taxes in this company and it's fine. And I'm paying myself like $45K. Usually it's about $45,000. They'll pay themselves $45K. They're drawing like all the profits out. They pay 25% and they're good. They think that everything's fine. Not the second year. Sometimes not even the second year. It's usually maybe even the third or fourth year the ATO comes calling because it's pretty obvious. They'll see this big amount that's sitting in loans that hasn't been paid back. And once the ATO checks it, they can cause that problem for you. Yeah. So the option also exists is if you have a trust as well. Let me just quickly explain the other option, like that it could also happen, even if you have a trust. So a lot of people think, oh, I have a trust, it's fine. I can just send the money into a trust. The way the trust works is, and everyone can see my screen, is that when you draw money from the company, wherever you put the money in the individual's name or where you put it in the trust, it still causes the same problem because the individual or the trust, the trust is still seen as an associate of it's the other way around. The individual is seen as an associate of the shareholder, and the shareholder is the trust. So, because the holding trust is beneficiary, like the beneficiary is the individual, so it causes the same problem whether you put the money in the trust or whether you put the money in the individual. The thing is with the ATO is that the only point of Division 7A, the reason why they have this is because they don't want you to avoid paying taxes. They want you to, they see that there's a 25% tax that you're paying. But if you take the money out and you put it into this person's name has a 45% tax. So they say, we're happy for you to leave the money in this company, not pay the tax on it. That's totally fine. Pay the 25% and don't pay any top up because it's in this company. But if you take it out, put in your personal name, that's when we want you to pay the actual top up tax. And the same thing applies to a trust because a trust doesn't actually have a tax rate. Its tax rate is NA, right? Because a trust, it passes all the profits. It's like one of our good friends, Sean, always says it's like a water pipe. The money gets, the money is like water and water gets passed through pipes and water shouldn't stay in the pipes. It has to flow out and it flows out to the beneficiaries. So that's why if you just lend money to a trust, and it doesn't have any tax rate, the ATO also wants to take that as Division 7A issues as well, and they want to tax it, and they would tax you at the heavy tax rate for trust, which is 45% if you haven't done it properly. Yeah, so the same thing happens. So you get like unfranked dividend to a trust. If the trust hasn't distributed the dividends, then the trust pays the hefty 45% tax as well. So like I said about the other example, you won't pick it up for the first year. Second year, might even not pick it up. ATO audits you in the third year and hits you for the last 3 years. That's how it works. And it's quite scary. Like a lot of people have been caught out. Thankfully, none of my clients have ever been caught out because we do the right thing. So what is the right thing? What are you supposed to do to avoid that situation? So I've just scared everyone, basically. But I haven't actually told you how it all works. Like what can we do to, avoid the situation, okay? And so this is where it gets quite juicy, where you can actually avoid it, right? And the way to avoid it is you actually take up a proper Division 7A loan agreement. So give me a second. Let me just pull that out. So there is this beautiful looking thing here, which is a loan agreement. It has to be prepared by the client, by the business. And what it is like the lender, XYZ Group, lends money to John Smith, who is either the shareholder or the director or anyone related to the shareholder. Okay, and it's a complete loan agreement in place, and there's interest that needs to be charged. There's a term. There's interest. There's it also talks about who the lender is and who the loan amount is. And the rule with the ATO is that there needs to be minimum yearly payments. That's the important part. All right, minimum yearly repayments. So you actually need to make a payment to this loan for it to be a loan. Okay, there's la-di-da-di-da in terms of defaults and all that stuff like that. No, all the rules of that. But the main thing that you need to know is that there needs to be repayments, and the minimum repayments are specified by the ATO. So the ATO actually has a calculator for you to work out what the minimum repayments are. And there's also interest that you have to calculate. And the interest is calculated by the ATO as well. So ATO releases every year what the benchmark interest you should be charging between this loan. And there's also a term sheet of how long you should repay this loan by. And that rule is usually 7 years, or if it's a secured loan, I think it's 25 years. So let me just quickly confirm that. 7A loan period. I think it's 7 years. So 7 years. Yeah, 25 years for the secured loan. So if you secure against the asset, so for example, let's say you took out $500,000 from the company, and then you put a security that the company now has a security on the asset that you purchased an asset with, with that loan. And so you can actually extend it for 25 years rather than 7 years. But the interest rate is really high. And the ATO benchmark interest rates are used to be 4.77% when the interest rate was 2%, but now it's gone up to about 8%. So when you think about it, most people won't, secure against a loan. They would do the 8%. So if you are a client of ours, well, all of you guys are clients, but if you have Division 7A problems, you may see that your company is receiving interest income, and that interest income is calculated by this benchmark, and we're against the loan that you've taken out of the company. So that will show up in your P&L as interest income, and then you also have a loan agreement in place that you've drafted up. And these are the terms. And you have to pay this loan within 7 years. So for that, going back to that example where the person took out $200,000 from the company, then they have 7 years to pay that money back. Okay, and this is not the correct way of calculating, but if you do 7 years, technically you'll have to pay $28,000 principal back every year until that gets paid back. Obviously, if you pay it $28,000 in the first year, then you actually have a smaller amount in the next year to pay back, so your repayments go smaller. But yeah, and then there's also interest that you need to calculate as well. So it's very hard to work out. But yes, within 7 years, you need to pay back that $200K. That's how the Division 7A rules work. Okay, so why would you do this over just treating as a wage or or repaying the money back like completely by the due date is because you don't mind paying interest on it. So let's just say that you went and invested that money into a property, like a rental property. You invested the money into buying shares. You get to, even though you're paying interest to your own company, the good thing is that that's tax deductible. So technically your investment in your personal name is negatively geared. So you can claim the Division 7A interest in your personal name, and then the company receives that income but pays 25% tax on it. So if you receive the profits in your personal name for that investment, then you would have paid taxes of 45% because your income is really high. Whereas in your company, it's 25%. Does that make sense, guys? Like why people actually like prefer to take up a Division 7A loan? Like you still have to make minimum repayments. You still have to pay the interest, but the interest is claimable in your personal name. So you can reduce your taxes on there and reduce your profits. And on top of that, the income that you receive in your company is 25% tax. So you actually move some of your profits and income into your company that has a lower tax rate. So that's why people like it. Okay. One thing I want to mention about Division 7A is that, yes, you have to have that interest benchmark. That's one of the main things. You have to actually follow the benchmark interest with the ATO. And you have to make minimum repayments. I know that's spelled wrong. I just shortened it. And then you have to have a loan agreement in place. But a lot of people don't. The interest is very easy to calculate. The accountant normally prepares that for you. It calculates that for you based on the loan agreement. The loan agreement, obviously, there's a template. I can send it to you if you ever need it. So that one's very easy to prepare as well. The last thing that you have the problem is always this, because you don't think about the loan. You don't actually think about this loan throughout the year or next year. So what you actually need to do, which we help you out on, is you go into the Division 7A calculator, the ATO, and then you actually put in the amounts that you borrowed, and it would automatically calculate how much your minimum repayments are. Okay. Sometimes throughout the year, you didn't actually make the minimum repayment. Okay. But you can actually still make the payment without actually physically making the payment. The way we do it is a lot of accountants out there take up a dividend. So a dividend paid from the company. So what would happen throughout the year is this company, again, like I said, made $400,000. Let's just say on the 1st of July, it declared that it's going to pay a dividend, 2023. So during the financial year, at the start of the financial year, it declared, I'm going to pay a dividend. And that dividend is going to be $30,000. I'll say, $35,000. So if it declares to pay a dividend of $35,000, it's actually made, instead of making a minimum repayment back to the company, you can offset the minimum repayment with the dividend. And that's how the ATO accepts that. Okay. There is a disclaimer I want to mention to you guys. Apparently, the ATO came out, I think like 2 months ago, and said that basically everyone that's been doing this rule that everyone has followed for the last 5 to 10 years, they say that it's wrong. And the reason why it's wrong is because every dollar that you withdraw out of the company, there should be a separate loan agreement for that dollar. So, for example, in July, you took out $10,000. There should be a loan agreement for that $10,000. Let's just say, and then August, you took out $20,000. There should be a loan agreement for that one too. So the ATO argued that everyone's been doing it wrong, because what the accountants and everyone does is they work out how much you've drawn out for the whole year, say that $200,000, and they create a loan agreement for that whole year. And that's like how this loan agreement is written up. And they just say for the borrower and the loan, the definition of loan is basically how much money that was drawn out. That's how it works in this rule. Loan. Yeah, so they don't specifically say the amount that has been drawn out in this loan agreement. It kind of just specifies the money that you've taken out for the whole year. The ATO came out recently and said that that's wrong. But I have to admit, everyone in whole of Australia has been doing it wrong. And I don't think the ATO is going to do anything about that to cause any problems for us. So just giving you guys a disclaimer that the ATO has said that everyone, basically 90% of all people have been doing Division 7A calculations incorrectly. It's not that incorrectly, it's just more of like the rules to satisfy the agreement. So the money that you take out is not like unfranked dividends and that make you pay tax on it. But as long as you have, I've sent a Division 7A loan agreement to the ATO before, and they ticked the boxes and said nothing. It's just one of the people in the ATO have raised that it's a problem. Okay, it looks like some people have asked some questions. Is the interest mandatory? Yes, it is. So you have to actually pay the interest. It's if you don't. So like I said before, there were like 4 main things you need to do. You need to have the benchmark interest. You need to make minimum repayments, and you can do that through dividends. You need to have a loan agreement in place. Like I said, like if you don't make the minimum repayments, you can take up a dividend. Those things have to be done in place. Okay, so now Lee also asked a question, are you talking about from a trust from a trading company? So it's not the trust making payments, it's the opposite. So it's the company drawing money out, the $400,000 that profit it made, and then paying the $200,000 to the trust. So the company is lending money to a trust. It's not the opposite where a trust is lending money over to a company. Oh, cool, that's a very actually good question. So if an individual lends money to a company, so if this individual sells his house, for example, and makes $1 million, and then decides, all right, I'm going to invest in this business, and I'm going to give $500,000 to this company. Is there Division 7A problems? The quick answer is no. Why does the ATO not care if they put $200,000 into a trading company or $1 million into a trading company? Is because when they sold the property or made the money, the tax has already been paid, and tax is probably like 45%, or it could be exempt from tax because it's capital gains exemption for main residents. But in the end, basically, tax has already been paid. It's paid at the highest tax bracket, most likely. So when you lend money to a trading company, which has a lower tax bracket, there is no problems. The ATO doesn't care about it. Same goes with the trust. Was there any other questions?
Just maybe 2 quick questions. One, how about the owner's deposits, like for bootstrap companies or something like that? So it's the other way around. I'm paying the company money and I want to take it later. Do I need a loan agreement for that?
Yeah. So, sorry. Just to go back into it, and sorry I cut you off so quick. Was there anything else you were asking, Anwar?
Yeah, the other one is also loans between companies. If I have 2 companies and I'm just sending the money from company A to company B.
Love it. I love these questions, by the way. Makes me feel like I've forgotten stuff. Yeah. So just to go back to that, the first question. The first question you're saying is what happens is the other way around. So it's the case that I'm said here. The company has, the personal shareholder or director has $1 million in cash, and then decides to give $500,000 to the company. So it's the opposite way around. The company is not taking money out to give to this individual. The individual is giving money over to this company. If that happens, it's called a credit loan. Why do I call it a credit loan? It's because in this balance sheet, it sits as a positive. So this one is a negative, but it sits as a positive liability. So the company owes the individual instead. That's what it means. In this case here, as I mentioned before, the tax rate for the personal, for the income that was generated to generate this $1 million was 45%, and it has already been paid. The ATO doesn't care about this side because the tax rate is 25% in the company, and the tax has already been paid for that $1 million. So the opposite, just going back to the short answer, opposite way, ATO doesn't care about it at all. Whether it's through the individual or trust, the trust would have paid the tax or the individual would have paid the tax. Opposite way, individual to company. ATO, there's no such thing. Division 7A doesn't even exist. You don't need a loan agreement in place. The ATO doesn't care about it. You can have a loan agreement just for your sake. If something bad happens to the company, you can claw the money back, and you can go to the liquidators and say, this company owes me money and I should have first dibs. That's why you should have a loan agreement in place. But for tax purposes, no, doesn't matter. Okay. And what you had a second question.
Yeah, the movement between if I have two companies and
Okay.
I'm kind of lending one of my company's money and returning it back.
Okay. So movement between two companies, when you lend money from one company to another, no Division 7A problems. Okay. Why do you think there's no problems? Because the whole point of Division 7A is to avoid you escaping the extra top-up tax. So what's the tax on a company? 25% or 30%? What's the tax on the other company? 25% or 30%? The ATO can't like use the rule that you're trying to avoid tax. You already paid the taxes. So when you borrow money from one company, lend it to another, no problems whatsoever. Cool. That's the quick answer towards that.
Let's say, for example, I'm already paying myself a wage at 100K or whatever it is, and I'm about to recognize another 100K worth in profit.
Yep.
So rather than me paying 25K in tax, company tax, can I just give myself a 7A loan? And then what is that like? Do I need to pay company tax on that before it goes out the door?
Yeah, that's a very good question. The answer is basically it's the loan repayment or the loan itself is not a tax deduction and it's not an expense. So when you open up the P&L, let me just pull this up. So this is can you guys see my screen still? Yeah. Okay. So this is like a P&L for a company, right? So you got the profit, the income here. You got the expenses. The expenses cost of sales, other income, and then the other expenses here. When you take up, so this is the profit. Say that you're referring to this year here, where you made $88,000. You don't want to pay the tax on this, and if you take up $88,000 as a bank transfer to your bank account, it never hits this P&L. What happens in the accounting side is it gets recorded in the balance sheet as a loan of $88,000. So it never gets taken as an expense in your P&L. So there's no like expense account called loan repayments. The expense account, the account it gets created is like a asset account that's called direct loan. So it never actually hits your P&L. Just yeah, I don't know if that. I need to go into that detail, but yeah, that quick answer is basically doesn't help you with reducing the taxes. In the end, you still show an $88,000 profit, no matter what if you've taken a loan and took it up as a drawing. The only way to
that makes sense. Thank you.
Yeah, the only way to like reduce your profits is actually take up expense. So there are a few ways. That's why we meet around April, May, and June. We say, okay, we send you an email usually, and we say, well, you've taken like zero money out of the company, but you've made a profit of, X amount. So say you've taken nothing out and you made a profit of $88,000. Then we go, okay, you can take up a wage or you take up a dividend. It's up to you. Let's decide in April to June what you want to do with it. But if you don't do anything, your tax ends up being, 25% of this. Yeah. That's why in April and June, we always make those decisions so we can decide on what we do. Because if you wait till 30th of June, it might be too late. What happens to profits made in a trust? The profits are then distributed to a company to reduce the beneficiary's tax burden. Does this trigger a loan? It triggers a loan if you don't actually send the money to a company. So if you say you made, $200,000 in the trust instead. So this is where it's the opposite way. So the company doesn't send money to a trust. It's where the trust made $200,000, maybe sold an asset, maybe made passive income. It's $200,000, and then instead sent the money, decided to distribute the profits to a company because the company has a 25% tax rate, whereas the individual was 45%, and there was nowhere else to put it in. And usually in this case, the company is a bucket company, they call it. Yeah, so that's what Lee's talking about. So what happens if we send this money over to the bucket company because it's taxed at 25%? It isn't a problem if you actually do the bank transfer. If you didn't do the bank transfer, what happens in the bucket company? Bucket company treats it as income because it's income distribution. But then on the opposite side, it's a loan because it hasn't been paid yet. So therefore, the trust owes the company, and then it creates a Division 7A problem. So if as long as you pay it to the company, you have no problems, Lee. But if you don't pay it and you take that money and put it somewhere else, then that's where you create a loan between the trust and the company. And it's the opposite way where the trust owes the money to the bucket company because the bucket company is supposed to receive the money but still hasn't. And that's where Division 7A happens. Yep. Cool. I hope that makes sense. All right. Does anyone have any other questions? It was a bit complicated, this one, but I think you guys asked really good questions. So actually made things actually quite good and exciting for me. Yeah. I think the main thing is we didn't really go through like what options you are, but it's very hard to answer the options. The options is based on your particular situation and what you want to do with the money. Do you want to invest the money in the company? Do you want to invest the money in your personal name? Are you buying, are you putting money on a deposit for a house? That there determines what you should do with your money. Where should you put it? Should you actually draw the money out? Or should you put it in a trust? Or should you put it in a company? Or should you lend the money to a company? It's very, very different. The main goal for this deep dive is actually just to tell you exactly what Division 7A is, how to ask the right questions, what you actually need, and how to avoid it. That's the main thing I wanted to do. When it comes to your situation, best to like book a meeting with me or my team members to help you guide you on what's the best option for you. Thank you guys and have a nice weekend.